Picture this. It is March 15th, 2008. Bear Stearns just collapsed overnight. Every hedge fund manager on Wall Street is in full panic mode. Phones ringing off the hook, traders throwing up in their trash cans. Senior partners at the most powerful firms in the world are genuinely terrified. And in the middle of all that chaos, one man is sitting completely still at his desk. Not because he does not understand what is happening, but because he positioned himself for exactly this moment months in advance. He is not reacting. He is executing a plan he wrote long before anyone else saw this coming. While everyone else was losing everything, he navigated the crisis with his capital largely intact and positioned himself to profit significantly in the months that followed. That man is Stanley Druckenmiller. And right now, in February 2026, his recent positioning suggests he may be preparing for something similar again. The last time he carried this kind of quiet confidence before a major event, $260 million followed. He is not guessing. He is not reacting to headlines or following the crowd. He has repeatedly pointed to 3 macro warning signs that have shown up before many major financial collapses. And right now, those 3 signals appear to be lining up more clearly than they have in decades. By the end of this video, you're going to understand exactly what those 3 warning signs are, why Druckenmiller believes the next major reset could be as severe as 2008 or potentially worse, and the precise move he is making right now to not just survive what is coming, but to profit from it massively. Stay with us until the very end, because the final section is where everything comes together into a clear and actionable picture. But before the 3 warning signs, there is one chart you need to understand, because without it, the full weight of what Druckenmiller is seeing simply does not land. For the first time in over 30 years, 2 lines that have historically moved together have violently split apart from each other. The first line measures how confident ordinary Americans feel about the stock market. Right now, it is sitting near one of the highest readings in decades, higher in fact than during the year 2000, which is widely remembered as one of the most dangerously euphoric and overheated periods in the entire history of financial markets. The second line measures how people feel about their own personal economic situation, their ability to pay rent, their ability to save, their sense of what the next 5 years look like for their family. That line is sitting near levels last seen during major crisis periods, including 2008. Think carefully about what that actually means in practical terms. People have never been more excited about stocks and never been more depressed about their own lives at the exact same time. That is not a minor statistical curiosity. That is a structural fracture running through the foundation of the entire financial system. Druckenmiller calls it exactly that, a stress fracture you cannot see from the surface. The building looks completely fine from the outside, but underground, the foundation is cracking. And at some point in every structure, the crack becomes too wide to hold. Here's the deeper economic reason that fracture exists. And this is the part that Druckenmiller says most mainstream commentators are completely missing. Since 2010, real personal income, meaning what ordinary working people actually earn after stripping out the effects of inflation, has grown by roughly 50%. That sounds reasonable until you place it next to the other number. In that exact same period, the inflation-adjusted return of the S&P 500 has been nearly 300%, 50% versus 300%. That is not a gap. That is a canyon that has been steadily widening for 15 years, and it is now wider than it has been at any point in modern financial history. Druckenmiller has studied every major market collapse going back to the 1920s, every single one. And in every single case, the crash did not come because things were obviously and visibly bad. It came because the distance between financial asset prices and underlying economic reality became too wide to sustain. The structure held until it suddenly did not. We are now looking at one of the widest gaps seen in modern market history. That is the once-in-a-generation setup. That is what everything else builds on. Now, here are the 3 warning signs. Warning sign number 1 is what Druckenmiller calls the debt-death spiral. The United States government currently carries over $30 trillion in total debt. That number alone is alarming enough. But the specific number that Druckenmiller says genuinely keeps him awake at night is not the principal balance, it is the interest. The U.S. government now pays $1.1 trillion every single year purely in interest payments, not reducing the actual debt by a single dollar, not building infrastructure, not funding schools or medical research or anything productive, just the annual cost of borrowing money that was already borrowed years and decades ago. Here's the number that visibly shocked even seasoned professionals inside the financial industry when it first became widely circulated. The United States government now spends more money on interest payments than on its entire military budget, more than the full cost of national defense, simply to service existing debt that continues growing every single day. And here is precisely where it becomes a spiral with no natural exit. The vast majority of that existing debt was issued when interest rates were near zero. As those bonds mature over the coming years and get refinanced at today's rates of 5% or higher, the interest bill does not stay at $1.1 trillion. It could rise sharply, potentially moving toward levels that would overwhelm the federal budget. The more you owe, the more you must borrow simply to pay the interest on what you already owe, which means you owe more, which means the interest climbs higher, which means you borrow more again. There is no mechanism built into the system that naturally interrupts that cycle. Druckenmiller's assessment is completely blunt. This is not political. It is not a partisan argument. It is arithmetic. And right now, the arithmetic is broken in a way it has never been broken before in the history of this country. Warning sign number 2 is what he calls the liquidity drain. Most investors look at a stock market sitting near all-time highs and conclude that everything beneath the surface must be fine. Druckenmiller has never operated that way. He does not look at the surface. He looks at the plumbing underneath. And right now, the plumbing is leaking in a way that is not visible to the vast majority of people who have money in the market. The U.S. Treasury needs to borrow approximately $2 trillion this year alone to fund its ongoing deficit. At the exact same time, the Federal Reserve is actively and deliberately shrinking its own balance sheet by $60 billion every single month as part of its quantitative tightening program. It is $720 billion per year being methodically removed from the financial system. Put those two numbers together. $2 trillion from Treasury borrowing, pulling liquidity out of the private economy. $720 billion from Federal Reserve balance sheet reduction. That is nearly $2.7 trillion of liquidity being drained from the financial system in a single calendar year. To give that number a scale that actually means something, the entire market capitalization of Apple, the single largest company in the world, is roughly $3 trillion. We are removing almost one entire Apple worth of money from the financial system every 12 months. And the overwhelming majority of everyday investors have absolutely no idea this is happening beneath the surface because the headline index number is still up, and the financial news still sounds broadly optimistic. Druckenmiller explains the sequence of events like this. Liquidity does not vanish overnight in a single dramatic moment. It drains in distinct and predictable stages. First, the most structurally fragile parts of the market begin showing cracks. Small cap stocks start quietly underperforming. Regional banks begin reporting uncomfortable numbers. Commercial real estate valuations start looking disconnected from reality. Then gradually the cracks spread to adjacent areas of the market. And then suddenly, and without what feels like adequate warning, everything collapses at once and virtually everyone reacts with shock and disbelief. Even though for anyone looking carefully below the surface, the warning signs were visible and measurable for months before the break. He says clearly and without ambiguity, we are in that slow drain phase right now. The cracks are already there for those willing to look. Warning sign number 3 is what Druckenmiller calls the credibility trap. And this one, he says, is what makes this particular once-in-a-lifetime moment fundamentally different from every crisis that came before it. Every single major financial crisis over the last 40 years had one reliable and consistently effective escape hatch, the Federal Reserve. In 1987, they cut rates and flooded the system with liquidity. Crisis resolved within months. In 2000, they cut rates from 6% all the way down to 1% over an extended period. Crisis eventually resolved. In 2008, they cut to zero and printed $4 trillion. Crisis resolved. In 2020, they printed $5 trillion in 6 months. Crisis resolved. The playbook worked every single time without exception, because every single time the Federal Reserve had meaningful room to act. There was always a lower interest rate they could cut to. There was always more money they could create. The ammunition was effectively unlimited. This time, that escape hatch is jammed completely shut. Inflation is still running above 3%. The Fed moves rates back toward zero right now. Inflation does not gently drift back up over a comfortable period of time. It explodes back toward 8 or 9%. Back to the kind of numbers that destroy the purchasing power of middle-class households within a matter of months and create genuine social and political instability. So the traditional emergency rescue cannot be deployed without triggering a different and equally serious crisis. For if they keep rates elevated, the compounding interest burden on $38 trillion in existing debt becomes catastrophic for the federal budget. And the broader economy slowly suffocates as capital is continuously drained away from productive use and redirected towards servicing debt that only keeps growing. Druckenmiller calls this the credibility trap, and it is precisely why he believes this reset will be worse than anything the current generation of investors has experienced. There is no good option left on the table, only bad and worse. For the first time in 4 decades of his career, the people responsible for managing financial crises do not have unlimited ammunition. The gun may be loaded with blanks, and the market does not yet fully understand that. Now here is something worth addressing directly, because most financial commentators get this completely wrong about Druckenmiller. They point out that he has been warning about structural problems for years and suggest he keeps being premature, and in fairness, that criticism has some basis. In 1999, he believed the technology bubble would burst in 2000. It actually burst in 2001. He was approximately 12 months early. That cost him real money, and he has said publicly that it hurt. But here is his precise response to that criticism that deserves careful attention. Being early is not the same as being wrong. Being early means you preserved your capital and you were positioned and ready when the turn finally arrived. Being wrong means you were wiped out and you were not around to participate in what followed. He frames it as a fundamental asymmetry that most investors never properly calculate. If he maintains a defensive posture and the market rises another 10% this year, he misses roughly 5% of gains after accounting for the yield on his cash holdings. That is genuinely annoying, but it is not fatal. If he is wrong in the other direction and he is fully invested and leveraged when the reset hits, the loss is not 5%. It is 30, 40, or 50% of everything, plus years of recovery time during which compounding works in reverse. The cost of being wrong on one side is a paper cut. The cost of being wrong on the other side is an artery. That asymmetry alone justifies his current positioning, regardless of exact timing. So what is Druckenmiller actually doing with his own capital right now? His approach breaks into 5 clear buckets, and the logic behind each one is worth understanding, because it is not arbitrary. Every allocation reflects a specific and deliberate response to the 3 warning signs above. 35% sits in cash and short-term treasury bills, currently earning around 5% risk-free. Most people hear this and immediately think it sounds lazy or overly cautious. Druckenmiller's response to that reaction is the same every time. Cash is not a position of weakness. Cash is optionality. Cash is the weapon you reach for when everyone else is being margin called and you can systematically acquire their best assets at 20 cents on the dollar. In 2007, he moved heavily into cash while the broader market was still near highs. Everyone around him called it overly conservative. Then 2008 arrived. He was the one with real firepower when fire sale prices appeared everywhere. 25% is deployed in short positions against the most structurally vulnerable areas of the market. Companies with unsustainable debt loads whose business models only function when money is cheap. Commercial real estate, or the gap between stated valuations and actual market reality has not yet been fully forced onto balance sheets. Regional banks carrying unrealized losses that become undeniable the moment depositor behavior changes and withdrawals accelerate. 20% is held in gold and precious metals, specifically through mining stocks that provide meaningful leverage to gold's price movements. When gold appreciates 20%, well-selected mining stocks have historically moved 60 to 80%. His underlying logic on gold has not changed in decades. Gold does not require anyone's promise or any institution's continued credibility. When trust in governments and central banks deteriorates, gold's value does not depend on a policy meeting or a press conference going the right way. 10% is allocated to energy, oil, natural gas, and uranium exposure. The reasoning is direct and almost elegant in its simplicity. The Federal Reserve can create infinite quantities of dollars with a few keystrokes that cannot create a single barrel of crude oil. When inflation returns in force, and Druckenmiller believes it will return with considerably more force than current consensus expects, energy holdings will be among the most effective stores of real value available. The remaining 10% is in defensive consumer staples. The companies selling soap, toothpaste, household products, and food staples. Companies that have genuine pricing power and generate consistent cash flow and maintain dividends even when growth assets are collapsing all around them. Even in a severe economic contraction, people continue buying the basics. Notice carefully what is completely absent from this entire portfolio. Very little exposure to the kinds of assets that have dominated retail speculation recently, including high-flying mega-cap tech and crypto-related themes. No recent initial public offerings. None of the assets that have made retail investors feel like permanent geniuses over the past 3 years. This is not a portfolio designed to maximize short-term returns or compete with the most aggressive growth strategies. It is a portfolio specifically engineered to survive the once-in-a-generation reset intact, preserve capital through the most dangerous phase, and then deploy massive concentrated firepower when quality assets are available at panic-driven discounts. Now here's the dimension of this situation that Druckenmiller speaks about openly, and that almost no other major investor is willing to say out loud. The primary reason most people will lose a significant portion of their accumulated wealth in the coming reset is not that they lacked information or access to good analysis. It is that they will be unable to manage their own psychology when the pressure becomes real and immediate. He has watched genuinely brilliant people with elite educations and decades of experience go completely bankrupt. Not because their fundamental analysis was flawed, but because they became too emotionally committed to their existing positions to change direction when the evidence clearly shifted against them. Your ego will cost you more over an investing lifetime than any individual bad stock take ever will. The moment you fall in love with a thesis, you stop perceiving reality accurately. You begin unconsciously filtering out every piece of evidence that contradicts your position and amplifying everything that appears to confirm it. That is not investing. That is expensive storytelling, and markets have no patience whatsoever for your narrative. His operational role in this is almost uncomfortably direct. When the facts change, you change your strategy. Not after a period of reflection, not after consulting with colleagues, immediately and without emotional attachment to what you believed before the facts changed. The investors who came through 2000 and 2008 with their wealth intact were not the ones with the most sophisticated quantitative models. They were the ones psychologically capable of being visibly wrong and moving forward without looking back. He also speaks with conviction about something most investors dramatically underestimated in its importance: the strategic power of deliberate inaction. In an environment where everyone is continuously reacting to every data release, every tweet, every earnings surprise, and every central bank statement, the single most powerful edge available to a prepared investor is the discipline to remain completely still and wait patiently for the specific setup that is genuinely worth acting on. Most investment losses over a lifetime do not originate from bad decisions made with full information. They come from unnecessary decisions, from trading when there was genuinely no trade worth making, from confusing constant activity with productive progress, from needing to feel engaged when patient inaction was actually the highest returning move available. The once-in-a-lifetime reset that Druckenmiller is describing will not announce itself with obvious clarity. It will begin looking exactly like a routine and manageable correction. A regional bank announces an unexpectedly difficult quarter. A significant corporate bond offering fails to find adequate buyers. 3 or 4 consecutive earnings reports disappoint in sectors that were previously considered unassailable. The financial media will characterize each of these as a contained and isolated incident. Experienced analysts will appear on television to explain clearly and confidently why there is nothing systemic to worry about and why the fundamentals remain sound. And then, with a speed that will genuinely surprise the vast majority of participants, it will no longer be isolated. Druckenmiller's entire 40-year career has been constructed on the ability to recognize that precise inflection point before it becomes visible and obvious to the broader market, not by claiming certainty about future events that nobody can predict with precision, but by reading the present environment with complete and ruthless honesty. By asking not what he wants to be true or what would be most convenient, but what the actual numbers say when examined without the filter of optimism or hope. Right now, the numbers say $38 trillion in debt, with a compounding and accelerating interest burden, $2.7 trillion in annual liquidity being methodically drained from the financial system. A Federal Reserve trapped between 2 genuinely bad options with no good ones remaining. A gap between financial asset prices and underlying economic reality that is wider than at any point in the last 100 years, and for the first time in 4 decades, a central bank that has genuinely run out of conventional ammunition. He is not betting on panic for emotional or ideological reasons. He is doing arithmetic. And arithmetic eventually asserts itself, regardless of how inconvenient the timing feels, or how much collective belief exists that this time might somehow be different. The investors who navigate this once-in-a-lifetime reset successfully, whose wealth is not just preserved but potentially multiplied on the other side, will not be the most optimistic people in the room during the decline. They will not be the ones who held on with the greatest conviction or took the largest risks at the worst possible moments. They will be the ones who understood the setup clearly enough and early enough to position for it before the crowd recognized what was happening. The ones who have meaningful cash reserves when the panic selling accelerated. The ones holding gold in short positions when everyone else was desperately liquidating their best assets, simply to meet margin calls and stay solvent another day. That preparation window is still open right now, but based on everything Druckenmiller is observing and positioning for, it will not remain open indefinitely, and by the time the reset becomes undeniable to everyone, the opportunity to prepare intelligently will have already passed. If this analysis gave you something genuinely useful today, subscribe to this channel. Every video here is built on a single, consistent foundation. Real research, real numbers,